Alliance Association Bank. Alliance Association Bank, we do exclusively HOA banking. So we are here for HOA specifically. We are a division of Western Alliance Bank, which is a large national bank, and we're just one of the divisions of this large bank. So we have been in business, Alliance Association Bank in particular has been in business about 15 years. We serve well over 23,000 associations. We have over 700 management companies, and we have over 100 employees dedicated just to Alliance Association Bank. And these numbers are probably a little dated, and believe that they're a little bit higher right now, but I don't have the specifics, so I don't want to overpromise. And just so you know, Alliance Association Bank was developed specifically for this type of issue in mind, the FDIC insurances and making things easier for HOAs to bank. And so to go over the FDIC insurance, FDIC was established in 1933 because of the Great Depression. Let me move this. I don't know if you guys can see that. Okay, let's go back. And so due to some of the bank's failures during the Great Depression, the United States created the FDIC and to create insurance protections for your deposits at the bank, so people wouldn't lose your money while they were set up at a bank. The FDIC insurance covers money deposited into a bank, and it's per your tax identification number. So for an association, it would be per your EIN number, what number is assigned to your association for tax purposes, and when you submit your tax reports. It's also based off of a social security number. So for me personally, if I bank with a bank, then my social security number is what they look to track the $250,000 insurance limit. If I wanted to go bank with multiple banks, then I could do that, and I would still have that FDIC protection within those multiple banks, up to $250,000 each. The same goes with the association. So part of the reason why Alliance Association Bank was created was to help HOAs manage that, and we are part of a network that then allows to do additional insurance coverage, which I will get to in a minute. And so this is basically kind of your basics of FDIC insurance, and we insure all deposits, so checking accounts, money market, CDs, and then the term CDARS and ICS, which I'll get to in just a minute. And so that would include, so if you had multiple accounts with us, that would include the total amount that you have deposited within us would be insured up to $250,000. And then amounts over and above the $250,000 is when we start to get into what we call the ICS and CDARS networks. So the IntraFi network is a company that was launched in 2002, primarily for the goal of creating this extra network of banks and ease of use for customers. So that's where the ICS and CDARS names come through. And ICS is equivalent to money market or savings accounts. And then CDARS is equivalent to your typical CDs, certificate of deposits. This is just kind of some history on the IntraFi. There's over 3,000 banks that are a member of the IntraFi network, ours being one of them. 10 out of the 10 largest banks in the US are included in the IntraFi network. Over 90% of US banks in the IntraFi network have more than 10 billion in assets. And we currently have around 500 billion in deposits using their services, Western Alliance Bank in total. So an ICS account is an insured cash sweep service. You can place funds in either using your demand or your savings options, your checking or your savings. And it allows you to continue to earn interest. It allows you to ensure a sweep where you can always keep your balances within Alliance Association Bank under that $250,000 threshold, as well as sweeping into other accounts outside of our bank within the IntraFi network, and keeping everything at under the $250,000 limit. One way we do that is when you want to open these ICS or CDARS accounts. Whenever we apply for that, we ask that you let us know where else you have money at other institutions, and that's put in our paperwork to the IntraFi network to ensure that we're not placing funds into those banks. So that's a very important key piece when we're setting up these accounts, that we ask for you to provide that information, because it's not information at our ready. And so that way, when we provide that information to the IntraFi company, they ensure that they do not place funds at those banks that you listed. With regards to the withdrawals, so on an ICS demand, you have unlimited withdrawals. With the ICS savings, you have 6 withdrawals. So if we go over those withdrawals, then there's penalties assessed, and that's per the federal government requirement. And a CDARS is basically a CD being placed within this IntraFi network. So it's, if you decide you want to place a $250,000 CD, then that money will go into a different bank placed as what we call a CDARS. And so for both of these options, we do not charge a fee to our clients for these accounts. The only fees would be if there was excessive withdrawals on the ICS savings option, or overdrawn accounts, but that's not typical. But there is a fee to subscribe to this IntraFi network, but we do not pass that fee to our individual clients or associations. This is, this is a general, overview, and our rates are published on our AAB rate sheet that we send out weekly. Your management company can provide that to you. And I do believe that they send that to you guys on a very frequent basis. With regards to using the IntraFi network, one of the perks is that you only have to worry about communicating with Alliance Association Bank. You don't have to worry about seeking bank statements from different banks. You'll get one consolidated bank statement from Alliance showing you where all of your money is and at which bank that it's at and how much is placed at that bank. If and when you want to open these accounts, it's a one-stop shop. We open them through Alliance, and then you don't have to worry about getting different information for different banks. So it's a very nice, convenient way to use the system. And so basically, this is kind of just a slide to show you. So you deposit the money with an Alliance Association Bank, and then the money gets placed into different banks when we're hitting that $250,000 threshold. So for most associations, I mean, there's large and small. And so there's a lot of associations that don't even necessarily need to worry about this, but then there are a number of associations that do. So it's kind of dependent on your association and what your needs are and what kind of reserves, operating, and then investment accounts you have and the money you're holding. So what I tell people to do is to typically review your balance sheet, determine where your balances are, what money you have at what account and what banks, determine how much liquid assets you need and how much you can potentially put into long-term investments. Look to see what your monthly contribution to your reserves are going to be that will add up over the year. And then also consider whatever projects you have to be funded in the next 1 to 2 years. And then based off of that information, you can develop a plan to figure out what money you need to have on the ready and available, what money you would need to have in an ICS type of sweep account, like demand account, where you can move money back and forth, and what kind of money you could place in a CD or CDARS option, which are typically higher rates of return. And I am always happy to kind of go over that with different boards if that's something that you are looking to do. And I would schedule an appointment with you guys in the future to do that. And what I would go over and what I'd have you prepare in the future or in advance is these items, you know, kind of get a game plan and what you guys are looking to do. And then also, if any time you have questions about certain investments or different rates coming your way, or the ICS and CDARS products, you know, in depth or more in depth than what we just went over, I'm happy to be available for that as well. And you can get my contact information through you know, RealManage to do so. And with that, I'm going to open it up to some questions. If anybody has questions on FDIC insurance in general or ICS and CDARS accounts. Cornelia? You're on mute though.
There. Can you hear me?
Yes, now we can.
Okay. All right. Thank you so much for opening up a question because I had one. What is the minimum amount over 250 that in the sweep would go to the next bank? So if we have 250,000 at your bank, but yet, and we can see where another 100,000 is there that we could put somewhere. So what I'm trying to say, is that enough to go into with the, you know, the CDARS or the ICS? You know what I'm saying? As you had those banks, 1, 2, 3.
Yeah. So anything like if you have, I would recommend if you have over $250,000, that we would create that ICS account at the very least. An ICS, either demand or savings, depending on what you guys need, but we would create that account and then we would create a threshold balance within AAB, and then anything over and above that threshold balance would sweep into that ICS account and be available for you to sweep back in if and when things are needed. And different associations are set up differently, and this would be something we would get together with your management team as well to determine what's best for you. But it is something where we would set up that account, and even if it's $1 over, we could set up that account $1 over the 250,000.
So I think what I'm saying is, okay, that dollar then is not insured by FDIC.
If we set up that account, then it would be.
So it would sweep. Okay.
Yes.
Okay. That was what, yeah. So I didn't know we had to have a whole nother 250, like 500,000, and then for it to sweep to another. Okay, I got it.
Nope.
Thank you.
It's anything over and above the 250,000. If we create, but we'd have to create that account. Like we'd have to make sure that we specifically create that account, and then we can create where anything that over that 250 threshold can be moved out into the IntraFi network items.
Good. Thank you.
You're welcome. Anyone else? You guys are an easy crowd. Okay, so if you guys come up with questions, please feel free to put it in the chat, and I'm going to turn the things over to Daniel now.
Yeah, hi there, everyone. Let me share my screen with my lending PowerPoint. Here we go. I think everyone can see that here. So again, my name is Daniel. I work for Western Alliance through Alliance Association Bank as well. I've worked in the industry on specifically HOA lending for the majority of my career, so over a decade now. Transitioning through, and just so you guys understand where I'm coming from, transitioning from loan administration, so working on the back end of it, so working with the attorneys, documentation, anything that happens throughout the life of the loan, into credit analysis, and so actually underwriting the deal, analyzing the risk associated with it, checking association metrics to make sure that it fits all the bank's guidelines and covenants, and then into kind of this more front-facing sales and support role to help out folks like Elise, who are boots on the ground for folks like yourselves in Arizona. So fun fact, while I help to service our West Coast lending operations for Alliance Association Bank, I actually live in the western suburbs of Chicago. So it's a little bit cooler than it is for you guys. I believe I was in Arizona last week and it was about 116, and it's a nice and breezy 75 for us here today. So a little bit of a difference when it comes to weather, but either way, we'll kind of dive into the information about HOA loans. And then certainly if anyone has any questions, fire away in the chat. If anyone wants to interrupt me, go right ahead. I welcome the attempt to ice me, I guess, so to speak, here on this. So let me make sure that this functions. So most importantly, who is the borrower when it comes to association loans? So in this case here, it's not the actual individual owners themselves, it's you as the association, so as a not-for-profit corporation. So think of this almost like a business loan. It's not as an individual loan. So with that in mind, how do we collateralize these loans? And so unlike a traditional mortgage or a commercial loan or a personal loan where there's tangible assets to grab onto, association collateralization is defined as the first assignment of the association's assessments and any assets that the association holds. So when I say assets, I don't necessarily mean the association's cash. I mean any hard assets the association might own in the way of things like units that you might have that we would file a general, if anyone's familiar with it, a UCC-1 financing statement, or otherwise typically things like lobby furniture, office equipment, or any other association-owned components that you could otherwise use to collateralize it. Now, again, because you have the situation where we're predominantly collateralizing this through the association's cash. So in this case, the assessments or special assessments, most associations don't have much in the way of tangible assets that you can collateralize it with. So that kind of ties into the next bullet point here. So who's responsible for the payment? In this case, since the association as a business is the one who's entering into the loan agreement, it's the association itself that is making the payment back to the bank. And pretty much any bank that operates within this space is going to take that via an ACH. So under extreme duress or circumstances, we can certainly accept manual payments. But just like a traditional commercial loan, if any of you are familiar with that, or a small business loan, all of that's going to get automatically debited. So in the immortal words of Ronco, you set it and forget it. So now when it comes to other information that you guys should know, so is a reserve study required? So not necessarily. However, when you have very large dollar loan amounts, or if you have loans that are for an elongated period, so think longer than 10 years as the bullet point states, then that might be a situation where any bank might ask you to get a professional reserve study. And predominantly that's because we want to understand what other kind of major capital projects or emergencies you foresee for X number of years, typically tied to the term of the loan. And that's really a metric that we use to help put you guys in the best financial footing to make the most educated decisions you can for the greater health of your association. So another item that I always get a lot of questions on this is prepayment. So a lot of banks will have various different prepayment clauses or structures. Traditionally, it will be based on refinancing of the loan with some other external bank. So unlike some other loan facilities, like I know some of the elongated or bundled home equity loans and things like that have just general prepayment penalties out of the gates. Association loans are typically based on prepayment by refinance through an external source. So in this case, another bank, especially when it comes to loans that are curated by special assessments. And for associations with flush financial situations where they can pay from their operating budget, it's almost imperative that the bank allows you to prepay those loans without any additional penalty. So as the bullet point shows here, items of unit sales, special assessment prepaids, insurance proceeds. I've seen situations where we've had mediation proceeds come in to help prepay a loan. All of that can be used without penalty from the bank to prepay that loan sooner. So as to the prepayment from the bank side, so a lot of banks have a lot of different metrics of how they calculate prepayment penalties. I've seen it anywhere from 2.5% to 10% of the outstanding balance at the time of prepayment. And I've also seen some other banks use a metric called yield maintenance. And just to make this as easy as possible for everybody, the way that you would define yield maintenance is basically, let's say you're 5 years into a 10-year loan, and then X bank will say, okay, you want to pay this thing in full by refinancing it with another bank. We are going to calculate the remaining interest you would have paid us for those last 5 years, and that's going to be your prepayment penalty. So I'm going to make a shameless plug here for Alliance. Our prepayment penalty is quite low for those refinances. It's only 2.5% of the outstanding balance at the time that you would make that prepayment. But as an anecdotal example, I was looking at an association loan a couple of months ago, and about half of the loan proceeds were going to be used to prepay a loan at another bank. And when we calculated that bank's yield maintenance prepayment penalty, it came out to several $100,000. So especially as you're looking out at other financial institutions, one of the first things you should take a look at, besides just the rate and the loan's covenants, is making sure that the prepayment is not exorbitant should you want to go refinance in the event of a complete change in economic circumstances. So then next, how can you fund these projects? And really it comes down to one of two options here, internal and external sources. So internal is probably pretty self-explanatory. You either have reserve funds on hand that you can pay for your project outright. You can either pass and collect a lump sum special assessment from your owners over X amount of time and pay for the project from the cash that you get from that. Or some associations are in a financial wherewithal where they can actually allocate money from their existing operating budget to support the loan's repayment. Externally, of course, there's a bank loan by going through someone like myself or a lease, and then there's private financing. So private financing is a little bit of a misnomer. There's a lot of components that go into it, but private financing would be individual owners going and using their own financial wherewithal and creditworthiness to apply for something like a home equity line of credit, a cash out refinance, or any other form of personal financing solutions. I have seen in certain circumstances where some associations have a very wealthy benefactor or owner that lives in the association who's willing to finance any kind of major project on behalf of the association for a nominal fee back to them. And in some extreme and relatively rare circumstances, there are opportunities for associations to take advantage of, government-backed programs. So things like grants, whether that be land grants or city or local county, or as many people saw through COVID, there are situations where certain associations under very unique circumstances can qualify for things like PPP loan proceeds or SBA loans, although that is few and far between. So then the advantages and disadvantages of each of the sources. So internal, obviously you're paying for it yourself. You don't have to pay me interest. So that in and of itself, great. And if you can do that, I would encourage you to do it every day of the week. Certainly, having a fully paid special assessment for those where you do have a lump sum special assessment that's due in order to fund said projects is also a great negotiating point for a lot of owners that are looking to sell their units. Dear prospective buyer, we just had a special assessment for $10,000 a unit. I paid my portion in full, so you can know with some reasonable amount of certainty that you aren't going to have any potential major capital expenses for the next X number of years. Disadvantages in regarding to that is if you're using your existing cash, you're bleeding into your coffers for future emergencies or other planned capital expenses you might have over X course of time. Typically, we see that as between 3 and 10 years. And certainly in the case of a lump sum special assessment, that can create financial hardship to owners. Under certain situations where you might have a more aging community where people might be on fixed incomes, telling an owner that they owe you, let's call it $10,000 to $20,000 in the next 90 days can be a little bit of a stressor, I would imagine. So that leads into the advantages of external sources. So you can keep your reserve funds and save them truly for emergencies or projects that you otherwise don't wish to borrow for. And then certainly when it comes to special assessments, especially, it can help reduce that adverse impact on the homeowners. And we'll get into a little more of that later, but special assessments, especially when they're being used to back a bank loan or otherwise to repay the bank loan, it really gives the owners options to either pay their portion up in cash prior to the loan commencing, or otherwise to amortize it through the association's loan that they'll take out on behalf of all of your homeowners to help spread those payments economically over 3, 5, 7, 10, sometimes more years. Disadvantages, of course, you're going to pay me interest. So that's the cost of doing business when you go out and get a bank loan. And then the other side of it is making sure you're adhering to bank covenants. So anytime you go out and get an association loan, any bank is going to have a series of financial rules that you as an association have to follow. And we'll go into some of those a little more towards the end of it. But those are things that both the board as well as the owners need to be aware of and understand. So you don't put yourself in a place where you could fall into a financial pit or otherwise default on the loan when you go to any said bank. So projects that are typically financed with a loan. So I'm not going to read through each of these individually, but most importantly at the bottom, the summary is the core component of this. So high dollar value capital improvements that you can't fit into your operating budget. So traditionally that's roofs. Along the California coastline, there's some regulation about decks and siding, as well as things like elevators, asphalt, etc. So I won't bore you guys with the specific details. Projects that typically a bank will not want to finance. And again, there's some examples listed here, but those are typically low dollar value projects that you can account for in your operating budget. So, again, the most important one of those is routine maintenance and repair. It's going to be tough for a bank to look at regular operating expenses or losses from your regular operating budget because of above and beyond expenses that will be recurring year over year as a good candidate in order to borrow. So then special assessments. I know we talked about this briefly, and I would say that arguably 75% of the time when I work with associations, the loans are repaid and supported through special assessments. And again, that's where giving the owners the options to either pay their lump sum in full prior to the loan commencing for those that have the financial wherewithal to do so, or otherwise for those who don't, to then opt into this amortization program that the association is basically going to take out on your behalf. So in these specific circumstances, the special assessment is passed based on the total project cost typically, and then each homeowner is assessed their fair share, whether that's equally across each of the individual units, or whether you have percentage ownership or square footage as directed by your governing documents. And then once that special assessment is in the passing phase, especially if you have an option to amortize it out over an association loan, so again, 3, 5, 7, 10 years, we always recommend that boards pass that special assessment to be inclusive of interest costs. And the reason we say that is that while owners who pay up front won't have that interest expense, those who opt into that amortization or spreading those payments out over the term of the association's loan will be responsible for those interest costs. So if you have $1 million project and you have 100 units and 50 opt to pay in full, those 50 owners would not pay interest back to the bank because their principal is paid off and the loan will be reduced commensurately. However, those that opt to amortize it over, say, 10 years, they're going to be responsible not only for the principal amounts that are stretched over that period of time, but also the interest that has to be paid back to the bank. So, and another way to consider this for everyone, if this can make a little more sense, is there's really two transactions at play here. So you have the special assessment, which is being assessed to the owners for the actual projects that you're taking on, as well as the loan's repayment. And then there's the loan itself. So the special assessment is between the owners and the association. And then the loan is between the association as a not-for-profit entity and the bank. And so basically what the association is doing in this case is taking the expense of the loan and passing that back through to the owners through your governing documents ability to enforce and regulate collection of your assessments and your special assessments. Once you actually end up passing that formal loan application, then you would basically complete a formal application with the bank. You would look to execute a term sheet, and then any owners that have that cash wherewithal or have another personal means that's maybe more economical for them to basically finance their portion would pay all of those lump sums up until the point when the loan would close, and anyone else would opt into that monthly payment plan. And then those that opt into said payment plan, those are the ones who are going to be funneling the money from individual owner to the association and the board, and then back to the bank to make the loan payments. So then this comes into the underwriting criteria. So what do banks look at? And a lot of this is more tailored to Alliance specifically, but again, having worked for a couple of different banks in this industry, a lot of this is basically the same wherever you might look. So delinquencies. Because associations are cash dependent in terms of the owner's ability to make those payments, so you can fund not only your operating expenses, but any capital expenses and or loan repayment, we want to make sure that the total number of owners who are delinquent in assessments or special assessments beyond 60 days does not breach 10% of the association. And it might seem a little bit silly to consider it that way, but consider again that the prompt payment of the assessments and special assessments is imperative to make sure that the association can pay back their obligation to the bank. Beyond that is general size constraints. So not only do most banks have a size constraint as to the community size, but also the loan amount. So more specifically for us, we traditionally look for associations that are 25 units or more. There's not to say that there might be exceptions to that rule where we can go a little bit below that. And then similarly on the loan amount, traditionally we want to see loans that are $100,000 or more. However, there are exceptions to that rule where sometimes we can bend a little bit below that. The next couple, I'm going to try to make this as easy as possible for you guys, but cash balances ties into a metric that we call association cash to assessment liquidity. So long and short, we want to make sure that your total cash is at least 20% of your annual regular assessments. And again, that's really just kind of a checkup, I guess, if I'm using medical terms, to make sure that you guys are in an economical place where you can continue to succeed and thrive as a condominium association. Beyond that, we want to know your repayment source. So when you come to the bank and you ask for a prospective loan, we want to make sure, how are you guys going to pay us back? Are you going to increase your dues just generally in order to support the cash flow the bank needs to meet our debt coverage and our other underwriting metrics? Are you going to pass a special assessment? Or do you have the wherewithal within your operating budget to support it? And we need to know that as soon as possible so we can appropriately help you plan for what comes next as you move through the loan process. Beyond that, so capital planning. What's your plan that the association has in order to cover future capital expenses or any emergencies? Traditionally, that would be supported by a reserve study, and especially with larger loan amounts and longer loan tenures, it's very important for the bank to get that snapshot of the financial health of the association over the last several years, as well as what you're projecting for the future to make sure that we're not helping you dig the pit that you might potentially jump into. Owner concentration and community support. So most banks will want to see at least 60% of the association as owner occupied, and that no one individual owner owns more than 10% of the association. So in other words, there's not one individual that holds X number of units that would breach that. And the reason being is, association lending is very unique in the sense that we want to make sure, condominium associations were originally built in the 70s as a way for people who wanted ownership in their home in order to share those expenses across a wider collective of individuals that have a similar mindset. So once you start getting below 60% owner occupancy or individuals with more than 10% ownership concentration, you're really leaning more towards, apartment building kind of scenarios, or a situation where one, let's call it a developer or an investor, can really control a lot of the business of the association. And that can lead to some credit pitfalls for the bank, which can make us a little bit nervous when it comes to those concentrations. And then last but not least, and arguably one of the most important, depending on your declarations and bylaws and any state and local statutes, we want to make sure that you have community support for any loan that you're looking to engage into. So especially as it relates to your governing documents, if you have requirements in order to obligate the association to a loan transaction, let's say over a certain dollar amount, in order to pass a special assessment, whether that's for repayment of the loan or for a project. And then also to make sure that you can pledge the collateral associated with the loan. So again, that assignment of the assessment. So the pledge of the association's cash flow to support the bank's repayment metrics. So how do loan structures work? And there's really two predominant aspects to that. So one is a construction line of credit. So for larger projects or projects that have nebulous costs associated with them, we can add something like a non-revolving line of credit, implying that you can borrow, but you cannot pay it back and then reborrow, because these are all tied to construction projects for anywhere between 12 and 24 months. And in those instances, based on the amounts that you would have outstanding in any given month. So just like, think of it like a credit card or a home equity line of credit. We're going to take the balance at the end of that given month, and then we're going to multiply it by the interest rate to give you interest only payments on the amounts that you have drawn. And then at the end of that construction or line of credit period, we would then amortize that out over the respective term of choice that would make the most sense for the association. So again, 3, 5, 7, and 10 are the most common. So on the other side of that, for associations that have project costs that are known, or you're going to otherwise complete construction relatively quickly, which I like to say within 12 months, then we do have fully funding term loans. So fully amortizing P&I from day one, just like your traditional mortgage. And those rates are oftentimes fixed when the loan goes to close. There are some extreme circumstances where sometimes banks can actually fix those rates at the origination of the loan, so implying they can fix it up front. But in this kind of an economic environment, that's more and more rare, if nigh impossible. And then so when it comes to both the line of credit and the term loan options, we want to make sure that the average useful life of the common element or the project that you're taking care of is going to exceed the term of the loan that you're taking out. So 1-year line of credit, 5-year loan, you're replacing your roofs. We want to make sure your roofs are going to last for at least 6 years or longer. And that's because we don't want to, again, put you guys in a financial pitfall where halfway through your project, that common component or common element goes bad. And then you either have to come back to us to borrow again, or you have to put your unit owners in a very dire circumstance where now you have to enact more extreme cash flow raising measures, a la one-time special assessments, excessive assessment increases, et cetera. And so the reason I was mentioning 3, 5, 7, and 10 specifically is most banks can fix rates for up to 10 years at a time. So traditionally, whether there's a line of credit involved or not, 10 years or less for your actual term of the loan is going to be the most advantageous because it's going to give you all a known cost. Most banks after 10 years, if not all banks, because I have to say most because I don't know with 100% certainty, but most, if not all banks over 10 years are going to require some form of rate reset. So in the example of 15 years, I oftentimes see banks that will have rate adjustments every 5 years, or sometimes they'll have them split down the middle. So after 7.5 years, in the example of a 15-year term. Additionally, unless your project is extremely massive, I'm talking, $10+ million at a time, most banks will not go beyond 15 years of amortization. It's very rare to see banks that will entertain 20 or 25 years or even longer. And the reason is when you're doing something like a roof replacement or a major capital replacement, you don't really want to hold a note on your balance sheet. It's just not fiscally responsible to keep it for longer than 15 years. And that ties back into the useful life of your common elements. So when you start trying to entertain options for things longer than 15 years, you're really looking at potentially exceeding the useful life of those elements, and therefore potentially digging yourself even deeper into that proverbial hole that I was mentioning. So what can you do as an association ahead of time to help secure the fact that you might be a qualified borrower? And the first is double check your governing documents. So talk to your management company, talk to your association attorney, and make sure that your governing documents, 1, allow you to borrow, 2, allow you to pass a special assessment or any other form of security that you need from the owners to secure that. So a la a unit owner vote at 2/3 or whatever your metric might be. And then also make sure that you guys can pledge your collateral. So a lot of times associations have caveats in their governing documents that restricts them from pledging the assessments as collateral in service of a bank loan without a unit owner vote. So the sooner you can review your governing documents to make sure that you have those provisions in place or not in place, then the better off you're going to be and the less nasty surprises you'll get when you actually go to fund that loan. Number two, self-explanatory. Make sure your delinquencies are as low as possible. So take a look at your owners that are past due beyond 60 days in assessments or previously existing special assessments and start collecting from those people. Use your management company, use your association counsel, and try to get those payments back up to date, or at least under 60 days in this case. So that way, when you go to a bank, you're not going to trip that covenant and automatically disqualify yourself. Additionally, take a look at any assessment increases you might need. Are you contributing less to reserves than you have in the past? Is your reserve contribution uncharacteristically low for an association of your size and constituency? Start doing those increases now, and maybe potentially even look at starting these special assessments in advance, because all of those will tie into what we would call bank cash flow. And cash flow is what the bank will review in your financial statements to ensure that you can repay the loan at an acceptable coverage to our specific metrics. Further, this one's not really something that you can always control, but if you can help it, try to limit your rental concentrations, as well as your individual investment owner concentrations. So if there's provisions in your bylaws that allows for 50% owner occupancy as the bare minimum, maybe think about adjusting that to 60%, or start thinking about potentially changing around or adding amendments to your governing documents to restrict the amount of units that one individual owner can buy. And then, of course, you want to make sure to update your reserve study as soon as possible. So any bank that you're working with can get the best financial picture of what you guys have done in the past and what you're planning to do in the future, as well as resolve any outstanding lawsuits, mediations, arbitrations, etc. So under extreme circumstances, there are conditions where a bank can lend to an association that's involved in a lawsuit, albeit that's few and far between. So if you have, let's say, a slip and fall at your association, or you're in mediation with a contractor that might have done deficient work, it behooves you when it comes to bank approvability to solve that as soon as possible before you come to the bank. Because as soon as we see someone that's involved in some kind of arbitration, mediation, or lawsuit, that's an immediate red flag when we're looking at a risk analysis. So then how does the process work? As always, whenever you're looking to do any kind of construction work, you should always at least get 3 quotes from different contractors to make sure that the bidding is competitive. From that point in time, you would want to reach out to a bank just like us, again, shameless plug here, to fill out what we would call a request for proposal document, or RFP, and provide current financials that someone like myself can use to analyze the terms and conditions of your specific association relative to the bank's guidelines. Assuming everything pans out appropriately, the bank will issue you a term sheet or a loan summary, and otherwise to outline the terms and conditions that the bank is willing to basically take to the next step, which would be the actual underwriting of the loan. And then the next one's a little bit off. It says board selects the highest and best offer. So highest is not necessarily the case. As a board, I'm assuming you're looking for the lowest interest rate in this case, but highest is really more referencing the dollar amount that helps you accomplish your project. And then once you find a lender that you're comfortable with, a lender that helped outline all of those terms and conditions appropriately and easily for you, then you would sign the term sheet, send any kind of commitment or origination fee back to the lender. The lender will move into the underwriting phase, ask you for a series of documentation, work through any questions about any oddities in the financials or specifics about the association, and then basically move you into that approval. So once a bank approves you, you'll collect a series of pre-closing checklist items. So any other ancillary information the bank hasn't collected yet from the underwriting team, and then otherwise issue out the loan documents for signing and closing, and then the subsequent loan funding. So roughly how long does that take? Because I think that's the most important aspect of this slide. Typically, most banks are going to take anywhere from, let's call it 60 to 90 days start to finish in order to fund a loan. So that's from the issuance of a term sheet all the way to when the money is either in your coffers or your line of credit is open and ready for you to use. So especially if you know that you have pending capital projects, let's say coming up in the spring next year, then I would recommend engaging that lender maybe beginning of January of 2024 to start that process. So that way you can align your funding with when your actual construction or project might start. Now, there are situations where banks can move faster. There are sometimes streamlined products that people can move through. but I always like to give people the most conservative analysis possible, and that's start early and talk to your bank as frequently as possible to make sure that you can set the right precedent with them and they can set the right precedent with you as to how long that process might take. Oop, my screen disappeared for a second. There we go. So then volatile interest rate environment. As everyone knows, the last 18 months here has been unprecedented when it comes to the increase in interest rates. So especially as a board and especially with the cost of time and materials going up as well, it really behooves you to analyze what your future capital projects are. And then not that I have a crystal ball because I can't predict where interest rates might go in the future, but everyone is telling us that they're just going to keep going up. And same thing with materials. So wood, for example, last summer was at, I think it was an all-time high for the last 20 years, I want to say. And same with labor. So in this kind of a rising rate environment, it definitely behooves the association to start this process or considering borrowing sooner than later. No one wants to be caught in a situation where you're a penny short, let's say 3 years down the road, and then you have to go back and reanalyze loan options, and then the interest rate has ballooned to 2 to 3 times what it was when you could have looked at it before. So really what this slide is trying to illustrate beyond just being conscious of interest rate and cost exposure is that the difference between the non-revolving line of credit converting to a term loan and the straight term loan. So this specific example here is just a case study that we used for an association loan that we were looking at sometime last year. And basically long and short is depending on the interest rate you're getting on your savings accounts over here, and depending on what that line of credit rate might be, and then whatever your outstandings might be in this column here, in certain cases, it's actually more economical and it will save you money to go with a straight term loan option as opposed to a non-revolving line of credit that converts to a term loan. So in this specific example here, the line of credit converting to the term loan scenario, so this is a 1-year line of credit converting to a 10-year term loan, was going to cost this association about $1.4 million in interest. Now, in a comparable term only scenario, just the interest on the term scenario was already lower than the total interest expense for this line of credit hybrid scenario. So at $1,056,000 in interest. But on top of that, the savings account for this specific association at the interest rate they were making then reduced the net interest expense to a point where it saved them even more money. So long and short, if you have a situation where you're debating a non-revolving line of credit versus a term loan, then humbly, I would just say reach out to me and Elise. I have plenty of different tools and resources that we use at the bank to help analyze cost savings for multiple different scenarios. And we're very, very happy to help you find the most advantageous option and the most economical option for your specific association. And hopefully someone from the bank doesn't reach down and punch me in the head for saying that, because my job in the end is to try to save you guys as much money as I possibly can. And so with that in mind, I will open it up for any questions from anybody.
I have a question. What is the most common reason you would see an association be denied for anything? Like, what do you see most often?
Typically delinquencies or lack of cash flow. So delinquencies is one of the hottest components of it. Cash flow, again, is kind of the components of an association's income and expense statement, or your profit and loss, for those of you who are familiar in that sense, that doesn't support repayment even with an event like a special assessment or an assessment increase.
Hi, I have a question. Can you hear me?
Yep, I can hear you just fine. Go ahead.
So have you ever, so you're a lender, correct? That's your business? Okay.
Correct.
So have you guys, I mean, I get it, like if you take out a loan, you have loan covenants and there's an issue like with your debt service ratio, for example, or delinquencies. But have you ever seen an instance where a lender would call a default where there's been a default on a non-monetary covenant? So for example, I've seen a loan where the documents were signed representing that it was a minimum 90% owner occupancy within the complex, which it has never even been close. And so
Sure.
I'm just curious, as long as you're making your payments and you're okay on your other monetary covenants, including like delinquencies, have you ever seen an instance where a lender would call a default for something like that?
Is it possible? Yes. Have I ever seen that? No.
Okay.
So, and actually, you bring up a good point, and I'm sorry, I'm going to digress for a quick second here. So again, doing HOA lending for most of my professional career, so to the tune of over a decade's worth of work here, and coming from a regional lender here in Chicago, where we process probably about 150 loan transactions a year, and then going to the other bank that I worked at as well, which was processing maybe 50 to 75 loans a year. And then Alliance, which has a pipeline that is just massive. It kind of blows me away sometimes. I've probably seen thousands of loans in my tenure in this industry, and I have not seen a single one go bad.
That's good.
So knock on wood, I'm not going to say it's not possible, but every bank that I've ever worked at has never had a charge off, a write off, or a forced default where we would call the loan. I think the only association loan I've ever heard of maybe going bad was there was that condo in Florida that collapsed in the ocean. And I think they had a line of credit with a bank, and I think that bank had to take a bath on it. And I didn't mean that as a terrible, untimely joke either.
Thank you. I appreciate it.
I have a question. When you talk about owner occupied, does that mean what happens if somebody owns a house, but they just use it as a second home versus renting it out to somebody? Does that count as owner occupied or what?
We would consider that owner occupied, correct? So when we say owner occupancy, when we're talking about leased units, we're talking about long-term leases. So investment properties that someone would buy and then rent out for the sake of making money, I guess, for lack of a better term.
Thank you.
Well, certainly feel free to pass my information along to anybody here on this chat or anyone else who might be interested in this. I'm going to try to be as humble as possible when I say this, but I've seen a lot of different scenarios in my career. So if you ever want to, bounce ideas off of me as to different ways that you can look at accomplishing your capital funding, we can get pretty creative here. So don't think that anything is strange, and don't think that any question is silly or inconsequential. That there's always a way that we can try to make something work for you guys, and we're here to support you as the owners, as well as Real as the management company. So however we can do that best, and however many times it takes for us to talk or meet, or any other involvement that we can help in order to make you guys feel comfortable as you're entering into financing, then we're very happy to be a part of it.
Yes, thank you. If any of you would like more in-depth information specific to your community, be sure to let your manager know. They definitely know how to get a hold of Daniel and everyone over at Alliance. So if you are, wondering, is this something that we need to look at for our association? Start with your community manager, and then they know how to get in contact with Alliance to maybe get some more information for you all.
Sure. And Marty, I saw you have a question to restate the leased units as owner, what considers a leased unit versus owner occupied. So a leased unit is considered a long-term scheduled lease. So in other words, someone who's an investor owner who rents out the unit full time. So owner occupied would be considered someone who either lives on the property 24/7. It could be a second home, a vacation home, or anything else that would otherwise constitute that owner as predominantly using their unit. So in another example, if you're, let's say, a family member and you're leasing the unit out to your son or daughter, you're absolutely allowed to do that. And that doesn't necessarily qualify as a leased unit because it's still quote unquote within the family.
Hi, Daniel. I have another question then. You just brought up something very interesting. So you're saying that if I own a unit and I'm renting it out to my daughter, that I don't have to consider that a leased unit or a rental unit. That would still be considered a form of owner occupied?
So typically units that are occupied by family members are still considered owner occupied because it's all within your relative, let's call it your nuclear family. So you might be renting it to your daughter and charging her rent in that instance, but it's still your unit. You're still responsible for it. It's just a family member that happens to be residing in that residence. So there are specific situations where that might not apply, but predominantly when we're talking about leased units, we're talking about investment properties.
Excellent. Thank you so much. I really appreciate that clarification.
Anyone else? All right, everyone, thank you so much for joining us. I'll hang out for a little bit in case anyone has any last minute questions. And then we'll wrap it up. We'll have the recording available on the board training site, so I'll make sure your manager sends that out to everyone. And as always, if you have any requests for future classes, let me know, and I would be happy to get Alliance back, or if it's regarding something else, we can definitely set that up, or we might already have that class available. So definitely let us know about that. I'm going to put my email in the chat, so if you want Daniel or Elise's personal email, let me know, or we can get you in contact with the rep for your community if needed. So
excuse me, I have one other question, please.
Good.
For Elise. Western Alliance, they've had some problems, I guess, with their people thinking that they don't have enough reserves or whatever else. Does Western Alliance go through any kind of a stress test that like the larger banks do?
Yes. Yeah, in fact, I would say that we go through some extra stress tests because of not being considered one of the larger banks. But we did just recently have our quarter wrap up where our CEO of the bank came out, gave some information. We're doing really well. We're doing better than anticipated by, a lot of the investors and people looking to see about the different bank strengths. And that information is on our website. And before we close the chat, I can look for it and give you guys that that information, like the link to it. But we did really well, and we're very, very solid in what we're doing in the strength of Western Alliance Bank in general. So we did come back even better than what was anticipated. Does that answer your question?
Yeah, you did.
Okay.
As long as we can take a look at it, see if we're on your website, because frankly, I don't think that banking system situation is over yet, especially since they just had one that failed here. They call it a merger, but it still failed.
PacWest, and yep, that is. They just did what they needed to do in order to secure their their banking, but the FDIC was not involved in that. But very good question. It is a very relevant topic, and I would agree that we're not out of the woods, like banking in general. But I do have a lot of confidence in our bank and the way that we've interacted with the FDIC, the safeguards that have been put in place, and we've done a lot of things to just ensure extra protections for our clients. So I'll find that, and I'm going to put it in this group chat once I find it to give to you guys.
Thank you.
Yeah, and I'm happy to answer those questions on an ongoing basis as well. So if and when those things pop up, Carmine, you just let me know.
Yeah, and then just so everyone else is even more comfortable, I will say the executives at all of our branches, as well as RealManage Corporate, are in frequent communication with everyone at the different banking partners involved, and they have definitely let us know that our business is a priority to them. So they've been very responsive anytime we've had the same concerns you all have had.
Yeah. And I'm always happy. Like, I get the concern, and we have every step of the way, anytime someone has a question, we have information and answers. So we take it seriously.